Hey there, hey, thanks for tuning in. Well, here we are in the beginning of February, and the calendar had barely flipped to 2022, and we are all quickly reminded that even attractive long-term stock returns come with a cost: volatility. From January 3rd through January 27th, the S&P dropped nearly 10%, in fear that the Federal Reserve will have to get a lot more aggressive to fight the inflation that we're all feeling. And then during the last two trading days of January, a 4% rally takes place and ends January down 5%. And all this happens right after how spoiled we all really were with such steady increase month after month in 2021. So it really wouldn't be surprising that this dip may have caught some of us off guard. For those whose anxiety levels may have risen a bit last month, let's take a look at some numbers or some data that may provide some reassurance. First, let's take a look at the positive years for the S&P 500. On average, the index experiences a maximum peak to trough decline of 11%, bringing this year's max drawdown so far to 9.8%. Then, on average, what happens after a correction of 10 to 15%, the index has experienced a one-year gain of 22% off those lows and has risen in 12 of the 13 one-year periods. And when you look at the Fed, what historically happens when the Fed starts raising rates, the average stock market gain 1 year after the first Fed rate hike of an economic cycle has been 11%, with gains the past 8 cycles dating back to 1983. So let's look at an investor sentiment survey that was done by the American Association of Individual Investors. Studies show when investor sentiment is most negative, as it was during the past couple weeks, stocks have gone up on average 11% in the next year. It's a good statistic to know right now, right? This data argues that we as stock investors should stay the course. But I think it will be important to remember and to point out that the gains in 2022 will most likely be tougher to come by than in 2021. They may be more modest, may happen later in the year, and that would be typical during a midterm election year in which we are in. But the good news is this, is that inflation peak may be near as the COVID-19 Omicron variant loses its punch. Slower but still solid economic growth this year will help cool inflation as the Federal Reserve starts to raise those rates. We're already seeing backlogs and bottlenecks start to clear, and we expect more people to jump back into the labor force later this year. And that would ease wage pressures. We may also get some help from lower oil prices, but that may have to wait a little while for Russia-Ukraine tensions to die down a bit. As you can see, there are some unknowns out there. As we all know, the market does not like uncertainty, and these uncertainties are definitely going to make the road ahead for stocks a little more tough. But the U.S. consumers and businesses, they're in excellent shape. The U.S. economy may grow 4% this year, well above the pace of the last decade. Corporate America during the fourth quarter earnings season shows us that it is thriving with S&P 500 earnings poised to increase by more than 25% year over year. So in looking forward, the stock market in 2022 will most likely be like the NFL playoff games played during the past 2 weekends, with a lot of back and forth between the Bulls and the Bears before the Bulls grind out a hard-fought win late in the game. Hey, that's all I have for you now. If you enjoy these market update videos, please subscribe and don't forget to like the video before leaving. Thanks for tuning in. We'll see you next time.